Something shifted in global capital flows over the past several months that most people completely missed. Japan, the largest foreign holder of U.S. Treasury bonds after China, has been systematically reducing their holdings. And the scale is massive. According to the most recent Treasury International Capital data published by the U.S. Treasury Department, Japan's holdings of U.S. government securities have declined by approximately $80 billion from their recent peak. That's not a small adjustment. That's a deliberate, sustained sell-off. And when the second largest creditor to the United States starts dumping bonds at that scale, you need to ask two questions. Why are they selling, and what are they buying instead? Because that $80 billion didn't disappear. It went somewhere. And when I trace the flows through Japanese Ministry of Finance data, Bank of Japan reports, and commodity import statistics, a pattern emerged. Japan is rotating out of U.S. treasuries and into hard assets, specifically gold and to a lesser extent other commodities and alternative reserves. Right now, as I'm connecting these dots, comment when you're watching this because these capital flows update monthly, and if you're seeing this in real time, you can track whether the trend I'm about to show you accelerates or reverses. And if you value macro analysis that follows the actual money flows instead of headlines, subscribe and comment FinTalk OG so the algorithm knows you're here for the data. Now, before I show you where Japan's money went, let me explain why this matters and why it's happening. Japan has held over $1 trillion in U.S. treasuries for years. They've been the most reliable buyer of U.S. government debt outside of the Federal Reserve itself. When Japan sells, it's not because they suddenly decided treasuries are bad investments. It's because their own domestic economic situation is forcing their hand. And that situation has everything to do with the yen, interest rates, and what's called the yen carry trade. Let me break that down because it's critical to understanding what's happening. For decades, Japan had near zero or negative interest rates. That made the yen a funding currency for what's called the carry trade. Here's how it worked. Investors and institutions would borrow yen at near 0% interest. They'd convert that yen into dollars or other currencies, and they'd invest in higher-yielding assets, U.S. stocks, bonds, real estate, emerging market debt, whatever. The spread between the near-zero borrowing cost in yen and the higher returns in dollar assets was free money. As long as the yen stayed weak or stable against the dollar, the trade worked beautifully. But in recent years, that trade started breaking. The Bank of Japan, after decades of ultra-loose monetary policy, began shifting toward policy normalization. They ended their negative interest rate policy. They started allowing yields on Japanese government bonds to rise. And critically, the yen started strengthening against the dollar, particularly during periods of global risk aversion. When the yen strengthens, carry trade positions blow up, because now you borrowed in yen, and when you have to pay back that yen, it costs more dollars than when you borrowed it. That's a loss. And when losses start mounting, investors unwind the carry trade. They sell their dollar-denominated assets, convert back to yen, and repay their loans. That's what's been happening. And one of the largest holders of dollar assets that's been forced to sell is Japan itself. Not just private investors, but Japanese financial institutions, pension funds, insurance companies, and even the Japanese government managing foreign exchange reserves. They've been selling U.S. treasuries to manage currency risk, to repatriate capital, and to reduce exposure to dollar volatility. Now let's look at the data. According to the U.S. Treasury's TIC data, which tracks foreign holdings of U.S. securities, Japan's holdings of U.S. Treasury securities peaked at approximately $1.12 trillion in early 2024. As of the most recent data available, that number has declined to around $1.04 trillion. That's roughly an $80 billion reduction. Now, Treasury holdings fluctuate month to month, so you need to look at the trend, not just one month. And the trend is clear. Japan has been a net seller for multiple consecutive months. This isn't noise. This is a sustained move. So where did the money go? Let me show you 3 places. First, gold. Japan's gold reserves, which are held by the Ministry of Finance and reported to the IMF, have increased. Not dramatically, but measurably. Japan historically held around 765 tons of gold, a number that stayed relatively static for years. Recent IMF data shows incremental additions to Japan's official gold reserves. The increases are small, 10 to 20 tons over the past year, but the direction is significant. For a country that barely touched its gold reserves for decades, any addition is a policy shift. But official reserves are only part of the story. Japanese institutional investors, pension funds, insurance companies, sovereign wealth vehicles have been increasing allocations to gold through other channels. Japanese import data from the Ministry of Finance shows that gold imports into Japan have surged. In recent reporting periods, Japan imported over 100 tons of gold, a significant increase compared to historical averages. Some of that is for jewelry and industrial use, but a large portion is investment-grade bullion. When you see import surges like that, it's institutions and high-net-worth individuals buying physical gold. Additionally, Japanese investors have been increasing holdings in gold ETFs and allocated gold accounts. Data from major gold ETFs like GIELD and international allocated storage providers show increased Japanese participation. This isn't retail buying gold eagles at a coin shop. This is institutional size capital moving into gold as a reserve asset and a hedge against currency and geopolitical risk. Second destination, other commodities and hard assets. Japanese entities have been increasing purchases of industrial metals, energy assets, and commodity-linked investments. This shows up in trade data and in corporate acquisition activity. Japanese trading houses, the Sogo Shosha like Mitsubishi Corporation, Mitsui, Sumitomo, have been expanding their commodity portfolios. They've been acquiring stakes in mining operations, energy projects, and agricultural assets. This is a rotation out of financial assets and into real assets. Third destination, repatriation and domestic investments. Some of the capital from Treasury sales has simply come home. Japanese companies and investors have been repatriating dollar earnings and converting them back to yen. This is partly defensive, protecting against further yen strengthening. And some of that capital is being invested domestically in Japanese equities, real estate, and infrastructure. This is a shift from foreign assets to domestic assets. Now let's talk about the macro implications. When Japan sells U.S. Treasuries at this scale, it puts upward pressure on U.S. interest rates. Why? Because if Japan isn't buying new treasuries and is actually selling old ones, someone else has to absorb that supply. And if demand doesn't match supply, prices fall and yields rise. Higher U.S. yields mean higher borrowing costs for the U.S. government, for corporations, for consumers. It tightens financial conditions. And it creates a feedback loop. Higher yields strengthen the dollar in the short term, which can cause more carry trade unwind, which causes more Treasury selling. It's a vicious cycle. But here's the twist. Higher U.S. yields also make Treasuries more attractive to new buyers, so at some point yields rise enough that other investors step in. But the transition period, when a major holder like Japan is selling and new buyers haven't fully replaced them, that's where you get volatility and instability. And we're in that transition period now. For gold and silver, this is structurally bullish. Here's why. When a major creditor nation like Japan loses confidence in holding dollar-denominated debt, or is forced to sell due to currency dynamics, it sends a signal to other holders. If Japan is diversifying away from treasuries, should we? That's the question other central banks and sovereign wealth funds are asking. And the answer for many is yes. Diversify into gold, into other currencies, into real assets. That creates persistent demand for alternative reserves. Additionally, the yen carry trade unwind creates global deleveraging. When leverage positions get unwound, it causes volatility across all asset classes. And in volatile environments, gold and silver tend to perform well as safe havens and as hedges against financial system stress. We saw this dynamic during the early stages of the yen strength in recent months. Gold spiked. Silver initially sold off due to the liquidation of leveraged positions, but then recovered as investors sought alternatives to financial assets. Now let's look at the specific evidence for Japan's gold buying. The World Gold Council publishes demand data, and their recent reports show that Japanese institutional demand for gold has increased significantly. Official sector purchases, which include central banks and government entities, have been a major driver of global gold demand. And Japan, while not as aggressive as China or Russia, has been a participant in that trend. Japanese financial press, publications like Nikkei and Bloomberg Japan, have reported on increased interest in gold among Japanese investors. There have been articles discussing gold as a hedge against yen volatility, against geopolitical risk, and against the uncertainty in global bond markets. When mainstream financial press in a country starts discussing gold as a legitimate allocation, it's a sign that institutional money is already moving in that direction. Here's another data point. Gold prices in yen terms have been hitting record highs. Even when gold in dollar terms was consolidating, gold in yen was making new highs because the yen was weakening earlier and then strengthening more recently. When investors in a country see gold in their home currency appreciating, it attracts more attention and more capital. Japanese investors have been watching gold in yen hit 9,000 yen per gram, 10,000 yen per gram, levels never seen before. That creates FOMO and momentum buying. Now let's talk about what this means for U.S. Treasuries and the dollar. If Japan continues to reduce Treasury holdings and if other major holders like China also reduce, the U.S. faces a funding problem. The U.S. government runs massive deficits, over $1 trillion per year in recent years. That deficit has to be financed by issuing bonds. If foreign buyers aren't absorbing those bonds, domestic buyers have to step up. The Fed, U.S. banks, pension funds, insurance companies, individual investors. But there's a limit to how much domestic demand can absorb, and if demand is insufficient, yields have to rise to attract buyers. Higher yields mean higher interest expense for the government, which makes the deficit worse, which requires more bond issuance, which puts more pressure on yields. It's a debt spiral dynamic. The dollar is also affected. When foreign holders sell treasuries, they're often converting dollars into other currencies or assets. That's dollar selling pressure. In the short term, if they're repatriating to yen, that strengthens the yen and weakens the dollar against the yen. But in the broader picture, it contributes to dollar weakness over time as confidence in dollar assets erodes. And a weaker dollar is bullish for gold and silver, which are priced in dollars. When the dollar falls, commodities priced in dollars become cheaper for foreign buyers, which increases demand. Here's the BRICS connection. Japan isn't part of BRICS, but the dynamic is similar. Diversification away from dollar assets is a global trend. China, Russia, India, Saudi Arabia, Japan, all of them are reducing dollar exposure to varying degrees. Japan's motivation is different. They're driven by domestic monetary policy and currency management, not by geopolitical rivalry with the U.S. But the effect is the same. Less demand for treasuries, more demand for alternative reserves, and that benefits gold and silver. Now let's talk about silver specifically. Silver hasn't gotten the same attention as gold in Japan's reserve diversification, but there are indirect flows. Japanese industrial companies are major consumers of silver. Electronics, solar panels, automotive, Japan has massive manufacturing sectors that use silver. As Japanese companies repatriate capital and invest domestically, some of that flows into securing supply chains for critical materials, including silver. Japanese trading houses have been involved in securing silver supply through long-term contracts and investments in silver mining projects. Additionally, if gold demand from Japan increases and gold prices rise, silver typically follows with a lag. The gold-silver ratio dynamics mean that when gold rallies, silver eventually catches up. And if Japanese investors who bought gold see silver as undervalued relative to gold, some of that capital rotates into silver. It's a secondary flow, but it's real. Here's what the market is underestimating. The yen carry trade unwind is not a one-time event. It's a process that could take years. Every time the Bank of Japan hints at further policy normalization, every time the yen strengthens, carry trade positions come under pressure and more unwinding happens. That means more treasury selling, more dollar liquidation, more rotation into hard assets. This is a multi-year structural shift, not a quarterly blip. And Japan is not alone. Other carry trade currencies, the Swiss franc, the euro in certain contexts, are also seeing similar dynamics. Global investors who funded themselves in low-rate currencies and invested in high-rate dollar assets are being forced to unwind, and the unwind creates a persistent bid for gold, for commodities, for anything that's not a leveraged financial asset. Now let's address the counter-arguments. Counter-argument 1. Maybe Japan is just rebalancing and will buy treasuries again when conditions stabilize. Possible. But the scale of the selling suggests this is more than a tactical rebalancing. This looks like a strategic shift driven by structural changes in Japan's monetary policy and currency dynamics. Even if they stop selling, they're unlikely to resume being a major net buyer the way they were in the past. Counterargument 2. Maybe the gold buying is overstated and most of Japan's capital is going into other assets. Fair. Gold is not the only destination. But even if gold is only 10 to 20% of the reallocated capital, that's still $8 to $16 billion flowing into gold from Japan alone. That's material demand. Counterargument 3. Maybe this doesn't matter for gold and silver prices because other buyers will absorb the treasuries and the system is fine, possible in the short term. But if multiple major holders are selling simultaneously, absorption becomes a problem. And even if the system doesn't break, the shift from financial assets to real assets is a long-term tailwind for precious metals. Here's my final take. Japan's $80 billion Treasury selloff is a symptom of a larger global shift. The era of endless foreign demand for U.S. government debt is ending, not overnight, but gradually. Japan's selling is driven by domestic factors, yen carry trade unwind, policy normalization, currency management. But the effect is the same as geopolitically motivated selling from China or Russia. Less demand for treasuries, more demand for alternatives. And gold is the primary beneficiary. Silver benefits secondarily through industrial demand, through correlation with gold, and through its role as a monetary metal. If you're holding gold or silver, Japan's move is validation. One of the most sophisticated, fiscally conservative nations in the world is reducing dollar assets and increasing hard asset exposure. That's a signal. If you're not in precious metals and you're wondering if the bull case is real, Japan's behavior is evidence that major players are positioning for a world where treasuries are not the default safe asset. Tell me in the comments, did you know Japan was selling treasuries at this scale? And do you think other countries will follow? Because if this trend spreads, we're looking at a structural repricing of global reserve assets, and precious metals are at the center of that repricing. If this breakdown connected the dots between Japan's treasury sales, the yen carry trade unwind, and the flight to gold, subscribe and comment FinTalk OG. And share this with someone trying to understand why gold keeps hitting new highs despite mainstream skepticism. One last thing. This is macro analysis based on official government data, treasury reports, and trade statistics. It's not financial advice. Markets are complex. Trends can reverse. I could be misreading the data. Use this as one input. Do your own research. And make decisions based on your own situation. All right, follow the flows, watch the data, and I'll see you in the next one.